Assalamu alaikum dear students. I hope you all are fine and safe. I am Dr. Tirmizi, your teacher and guide of Corporate Governance course. Today we will discuss chapter number 12, that is institutional shareholders and activist investors. The main topics that we will cover in this chapter are listed in the next slide. For your reading and understanding, I hope you will find this video lecture useful to learn and clear topics as well as concepts discussed in the chapter number 12 lecture of corporate governance. Class, in chapter number 12, the market for corporate control. The major topics that will be covered starts with the introduction of the chapter. Then we will discuss the second topic, that is the role of shareholders. The third topic of the lecture is block holders and institutional investors. The fourth topic is institutional investors and proxy voting. Then we will discuss activist investors as the fifth topic of this lecture. The sixth topic of the lecture is shareholders, democracy and corporate engagement. The last and seventh topic of this lecture is proxy advisory firms. At the end of this lecture, I will discuss with you the Harvard Business Review Article 12.1 reading assignment as well as details relating quiz of chapter number 12. The details relating completion of Article 12.1 reading assignment and quiz of chapter number 12 have been shared on the Corporate Governance Microsoft Teams class platform online. We start our discussion of chapter number 12 by examining the broad universe of institutional investors to understand their objectives and the methods they use to gain influence on company affairs. We will then learn about the role that proxy advisory firms play in influencing the annual voting process. Lastly, we will learn about the regulatory changes relating trends towards shareholder democracy and corporate engagement. Therefore, in general, in this lecture, we will discuss about institutional investors who have only indirect influence on companies' affairs. The majority of their influence must be exerted through the board of directors, whom they elect to govern on their behalf. However, institutional shareholders can still be powerful. They can communicate their opinions directly to management and the board. If the response they receive is not satisfactory, they can seek to have directors removed, vote against proxy proposals sponsored by management, put forward their own proxy measures, or express their dissatisfaction by selling their shares. We will move from topic to topic in this lecture and gain valuable knowledge relating to chapter number 12, that is institutional shareholders and activist investors. Class, now we will discuss the second topic of this lecture, which is the role of shareholders. We already know that as per the shareholder perspective of the corporation, which states that the primary purpose of the corporation is to maximize wealth for owners, which are the shareholders. This implies that the question of effective governance from the standpoint of shareholders is quite simple. That is, particularly, governance practices should seek to create better alignment between management and shareholders' interests, thereby reducing agency costs and increasing shareholder value. Therefore, effective governance focuses on the best way to create this alignment and increase shareholder value. In spite of this simple explanation of effective governance, disagreements arises among shareholders about the best way to structure a firm's governance because shareholders themselves are not a homogeneous group. Because they are particularly different. Shareholders are different. They differ in terms of several important attributes. For example, shareholders do not have a single common interest towards investment horizon, have different objectives, do not exhibit the same activity level, and also vary by size. This means investors with a shorter investment horizon try to prefer management to focus on maximizing near-term earnings and stock price as compared to long-term investors. On the other hand, a large mutual fund institution might only care about the economic results of the corporation An institutional investor that represents a specific constituent, such as a union pension fund or socially responsible investment fund, might focus on how economic results are achieved and the impact on various stakeholders. Similarly, passive investors such as index funds attempt to generate results in terms of returns that mirror the returns of a predetermined market index. So, particularly, this means that the generated returns must be as according to the returns of the market index. They might be less attentive to firm specific performance and governance matters as compared to activated or active investors who are active in the trading of company securities and care greatly about individual firm outcomes. They might also try to influence corporate affairs by meeting with management, lobbying to have board members removed, voicing concerns about compensation practices, and advancing policy measures through the company proxy. In the case of shareholders that vary by size, for example, the large institutional investors tend to have significant financial resources that they can dedicate to governance matters of a firm. So the heterogeneity of shareholder groups creates a coordination problem which leads to free rider problem, where one institutional investor bears the cost and the benefits are enjoyed broadly by all shareholders, who are said to enjoy a free ride. For example, an activist institution fund might lead a successful campaign to de-stagger a company board or remove economically harmful anti-takeover protections. Although all shareholders enjoy the outcome of this effort, the activist investor alone incurs the cost of all this activity. Class, now we will discuss the third topic of this lecture, which is blockholders and institutional investors. The concept of blockholder states that a blockholder is an investor with a significant ownership position in a company's common stock. No regulatory statutes classifies an investor as a blockholder, although researchers generally define a blockholder as any shareholder with at least a 1 to 5% stake. A blockholder can be an executive, a director, an individual shareholder, another corporation, a foreign government, or an institutional investor. Conversely, institutional investors include mutual funds, pension funds, endowments, hedge funds, and other investment groups. For the purpose of this chapter, we limit our discussion to non-executive and institutional blockholders. Blockholders are predominantly institutions rather than individuals. Among a sample of randomly selected manufacturing firms with blockholders, if they decide to act, institutional investors and blockholders are in a position to impose governance reforms on corporations. Their significant voting stakes can determine the outcome of a contested director election or proxy proposal. They can change the outcome of a heated takeover battle or prod a company to put itself up for sale or change strategy. If they hold a large enough position, they can gain board representation and directly influence strategy, risk management, executive compensation, and succession planning. However, the blockholders' influence likely depend on the nature of the investment, the nature of the investor, and the relationship between the investor and the corporation. For example, Toyota likely has a different relationship with the auto suppliers it invests in than does a large institutional owners or an activist hedge fund. Class, now watch an online video relating the power of institutional investors.
People who trade stocks are broadly defined into one of two groups: institutional investors and individual investors. Institutional investors are the professionals who manage the trillions of dollars invested in mutual funds, investment banks, hedge funds, and the like. Individual investors, also referred to as retail investors, are people who independently invest for their own private accounts. Studies have shown that institutional investors, who account for roughly 70% of the trading volume in stocks, can and do move the market due to the large amounts of money they invest with. Because of this, the market has a tendency to move in the same direction as these institutional investors. Here at Zacks, we have always known about the power of the institutional investor. Through the Zacks rank, you can benefit by getting into the stocks that are highly sought after by these large professionals due to their focus on earnings estimate revisions. Most institutional investors attended prestigious business schools where they were taught a number of classical financial models, many of which were designed to calculate the fair value of a company and of its shares. Almost without exception, these valuation models focus on earnings and earnings estimates. Very simply, if you raise the earnings estimates used in the model, then it will create a higher fair value for the company and its stock price. For example, if an analyst believes a stock is worth 20 times next year's earnings, a PE of 20, with an earnings estimate of $1 per share, that's $1 estimated EPS, then it would be under its fair value at any price below $20. That's a PE of 20 times the $1 earnings estimate, equaling $20. If the analyst changes his forecast and believes the company will instead earn $1.10 per share, the fair value would then be $22. That's the PE of 20 times the new estimate of $1.10, equaling $22. Institutional investors then act on these changes in earnings estimates, typically buying those companies with rising earnings estimates and selling those with falling earnings estimates. As you can see, an increase in the earnings estimate can translate into a higher price for the stock and bigger gains for the investor. It's also important to note that it can take weeks, if not months, for an institutional investor to build a position given their size. The individual investor, however, who can get in at the first sign of upward earnings estimate revisions, like those with a new Zacks #1 rank, has a distinct advantage over these larger investors and can benefit by the expected institutional buying that will follow. It's why Keith S. of Tulsa, Oklahoma writes, "I started using Zacks in 2003 and have beaten the market every year since then."
Class, now we will discuss the fourth topic of this lecture, which is institutional investors and proxy voting. Publicly traded corporations are required by the state law or the law of the country to hold an annual meeting of shareholders to elect the board of directors and transact other business that requires shareholder approval. In the United States, shareholders are provided advance notice of the annual meeting through a written proxy statement, and they vote their shares on ballot items in person or by proxy over the internet, via the phone, or by mail. Because of their size, institutional investors are in a better position than individuals to impose governance changes through the proxy voting process. They might exercise this influence by voting against management recommendations on company-sponsored proxy matters such as director elections, auditor rectification, equity-based compensation plans, and proposed by-law amendments. Furthermore, they might sponsor or vote in favor of shareholders' resolutions that recommend or require by-law amendments or policy changes not sought by the corporation. Class, now we will discuss the fifth topic of this lecture, which is activist investors. An activist investor is a shareholder who uses an ownership position to actively pursue governance changes at a corporation. Any activist investor, or you can say the investor, can employ an activist strategy, including a union-backed pension fund, an institutional investor with an environmental, religious, or social mission, a hedge fund, or an individual investor with outspoken beliefs. Activists use lobbying efforts to increase leverage and influence corporate governance outcomes beyond what can be achieved by simply voting shares in the proportion of their ownership position. Although activists might have a stated objective of improving shareholder value, they also might have secondary motives that are not value enhancing for shareholders over the long term. Activists use a variety of mechanisms to influence corporate policy, including sponsoring proposals on the proxy contests. These contexts are particularly threatened or basically based on actual. So this can be exercised. Other is pressure through the media and other public forums and direct engagement. Shareholders can also influence corporate policy through a proxy contest, as I already told to you. In a proxy contest, an activist shareholder nominates its own slate of directors to the company's board, known as dissident slate. The proxy contest represents a direct attempt to gain control of the board and alter corporate policy, and it is usually attempted in combination with a hostile takeover. The proxy contests require significant out-of-pocket expense by the activist shareholder, including purchasing the list of shareholders, preparing and distributing proxy materials, and soliciting a favorable response from key institutional investors. The cost and risk of failure substantially limit the frequency of proxy contests. However, many contests like this one, which I discussed to you earlier, can make a particular activity successful. So they can be successful in these type of attempts. Shareholder activism remains a highly controversial topic. This is true. So in this case, proponents of activism argue that the companies with an engaged shareholder base, this is very important, engaged shareholders base in a corporation, are more likely to be successful in the long term. Active shareholders reduce agency problems, limit management entrenchment, and combat complacency by exerting pressures on corporate officials to put the interest of shareholders first. So this is very important, that the interest of the shareholders must be the prime responsibility, and in this case it has to be exercised. So under this argument, activists are a necessary element of the market for corporate control. The various forms of shareholder activism particularly include activism by pension funds, socially responsible investment funds, and hedge funds. So the assignment I already given to you in the case of reading is assignment of Harvard Business Review, that also embarks on this particular importance of activist investors relating a corporation. So if the activist investors are active in a corporation, so certainly that corporation can achieve higher share price in the market, as well as a result can gain higher value for its shareholders. Now class, watch an online video relating the increase in activist investors' influence globally.
Corporate raiders were the stars of Wall Street in the 1980s. The new generation of troublemakers for chief executives are activist investors. Activist shareholders targeted the largest number of companies ever in 2018. A record 226 companies faced activist campaigns. One way to imagine activists is as the populists of finance. These investors, usually hedge funds, build small stakes in a company where they believe the share price can perform better. In the name of shareholder democracy, they demand their voice for change be heard, or else. The activist toolkit for seeking these changes is diverse, but in general, they are looking to shake up a company to boost its stock price. That could mean pushing for divestments, or demanding that it should explore a sale. If they don't get their way, they will seek to replace a chief executive, a board member, or even a majority of the board. The first approach between an activist and management is usually private, perhaps through a letter. If the company doesn't comply or respond adequately, the activists will look to take their demands public. And that is when things can get ugly. Measures taken might include media campaigns to discredit management or board members. Some of the masters of the activist universe are Paul Singer of Elliott Management, Jeff Ubben of ValueAct, Nelson Peltz of Tryon Partners, and Carl Icahn, originally a corporate raider. Each professes to have their own unique style, but either way, these strategies are proliferating. In 2018, activists deployed the most capital ever. The amount invested in targets reached a high of $65 billion. With that money, they've won a record number of board seats in target companies. And the trend is not stopping. Activist investors have historically focused on mid-sized US companies. That's partly because they're the ones that are easier to target, with fewer tools to defend themselves. But large funds are increasingly going after bigger and bigger targets and expanding their reach to Europe and Asia. We should expect more and more audacious activist campaigns in the year to come, as the appetite for corporate change is far from waning.
Class, now we will discuss the sixth topic of this lecture, which is shareholder democracy and corporate engagement. In recent years, governments and governance experts have increased their efforts to influence shareholders over corporate governance systems, which is broadly labeled as shareholder democracy. These efforts are intended to give shareholders a greater say in corporate matters, which result into direct engagement between shareholders and the board of directors. Advocates of shareholder democracy believe that it will make board members more accountable to shareholders and possibly stakeholders' objectives. Elements of shareholder democracy include majority voting in uncontested director elections, proxy access, say on pay, and other voting related issues. Closely related to shareholder democracy is the issue of direct engagement between shareholders and the board of directors. Class, you can read details relating the elements of shareholders democracy provided in the course book of corporate governance, that is Corporate Governance Matters, from page number 360 to 364. Class, now watch an online video which explains that if shareholders engage in disputes, it could destroy the value of the entire business.
Hi, my name is Tim Holmes. I'm the Senior Partner for Growth for Syed Group. And I'm talking to you today about how shareholders' disputes can completely destroy value in a business. In our experiences dealing with quite a lot of boards, almost all of the companies we deal with have some kind of shareholder, not so much dispute, but there's a disagreement between shareholders. And that's fine if it's managed and kept to a minimum and you have the discussions and it's all very amicable and we resolve it. But where it becomes a problem is where those disputes just escalate and get worse and worse and worse and become the focus of attention at the board level. So for example, a few years ago we had a company we were working with where the couple, the wife was the MD and the husband was the director, and they went through a divorce. And this kind of things happen. But the problem with both people being in the business was the divorce started to drive the behavior at board level, and the disagreement between the shareholders started to dominate the conversation to the point where decisions weren't being made. The company had a bit of a wobble. Now shareholders don't want to invest because they're arguing about their assets, et cetera, et cetera. And if it's not dealt with by those two individuals timeously, then the whole company starts to unravel and eventually ends up going to liquidation, and no one wins. In that case, we tried whatever we could to help them with that dispute, but it just never got resolved. So one of the things that we've learned along the way is that if you don't have some kind of independent perspective in a boardroom, and particularly where you have a boardroom dominated by two shareholders or significant shareholders or majority shareholders, it's really difficult to break the conversation between shareholders, directors, and managers and push that shareholder conversation out of the room, because it needs to be dealt with out of the room, and it can't be allowed to impact the business performance and the business decision-making process. So what we always recommend is that you have at least the chairman as the independent. And for a private company, that's typically not where people are starting. They've got either the majority shareholder or the founder, and they may be the same person who's the chairman, and that's the role they expect to take in the board. But if there's any kind of dispute, then it's really difficult to break that conversation. So one of the key things is to try and get an independent chairperson into that room. And then as an independent chairperson, so from my experience, being that individual that's being bombarded from all sides by the fighting shareholders, it's really important to have some kind of energetic independence behind you to say, okay, now we've got a team approaching this problem rather than you being all on your own. So we would always, as a SIRDAR perspective, always trying to have at least 2 independent directors in the room, because then it's not just a meeting with so-and-so, it's a meeting between the independent directors and the executive directors, and it's a proper board conversation. And you can start breaking down those barriers and saying, right, that's a shareholder discussion, park it, we discussed it in the shareholders meeting, this is a board discussion, we're talking about the strategy, we're talking what's in the best interest of the business, this is a selfless conversation. And then it's a management conversation, that's operational, you must park that, you must have that at an executive level, and we determine as a board what are the key strategic objectives that the management then implement. So really it's about trying to diffuse that emotional conflict between the parties that are the majority shareholders by focusing what are the issues that are in the best interest of the business. And really the only way you can successfully do that, unless the individuals sort it out themselves, is to bring in some kind of independent perspective at board level. Hope that was useful. I hope it helps you change your relationship on your board. If you need any help or support, then please come to our website, sirdargroup.com, and we'll see if we can help you.
Now we will discuss the 7th and the last topic of this lecture, which is proxy advisory firms. Many institutional investors rely on a proxy advisory firm to assist them in voting the company proxy and fulfilling the fiduciary responsibilities to vote the shares on behalf of clients. The largest proxy advisory firms are Institutional Shareholder Services (ISS) and Glass Lewis and Company in United States of America, whose clients manage $25 trillion and $15 trillion in assets. Therefore, institutional investors must consider benefits as well as drawbacks of hiring a proxy advisory firm, because institutional investors are ultimately responsible for fiduciary duties to ensure that their votes are in the best interest of their shareholders. Now class, the article I have given you to complete is relating Harvard Business Review. So the title of the article is What CEOs Get Wrong About Activist Investors. This article has already been uploaded on Microsoft Teams class platform of corporate governance. So what you have to do is, you have to use Microsoft Teams corporate governance class platform to read this article 12.1. So after reading the article, you have to use MS Word Online and type 1 to 2 page article review in your own words, and then you have to turn the review of the article in under the assignments tab. The assignment 12.1 submission deadline is also been mentioned on the Microsoft Teams class platform of corporate governance, and also the details related to the pending quizzes of earlier chapters covered in terms of video lectures. That's the end of the lecture relating chapter number 12 of corporate governance. I hope all of you have gained knowledge relating topics and concepts we have covered in this lecture. You all are encouraged to review the video lecture, this particular video lecture of chapter number 12, and ask questions relating this lecture on corporate governance Microsoft Teams class platform. Now you will see me in the next video lecture relating chapter number 14 of corporate governance. Until then, goodbye and Allah Hafiz.